dive in. One thing I want to talk about quickly in recession, and a lot of what I'm going to say is going to complement and supplement what Will said. What I'm hearing throughout the media is that the recession is going to be mild. I was talking to Sam Stovall yesterday at another webinar, and he thinks it's more like 1990 than 2008. So he's thinking a mild recession. And then on Financial Advisor magazine, FA magazine, said there's little danger of serious recession. The consensus is it's going to be light. Now, my gut instinct is to say when everybody agrees on something, they're probably wrong. I don't know how much I trust that opinion. It certainly could be, and it'd be fantastic. But there are a lot of things that could snowball into something much worse, like we saw in the banking a couple of weeks ago. That could have gotten very, very bad very, very quickly. But the government stepped in and backstopped a lot of that stuff. But if that happened to more banks, I mean, we could have had something much, much bigger. So we have people like Jamie Dimon, Warren Buffett, a lot of other banking sectors are saying more banks are going to fail, but we're not seeing it yet. So I'm really curious as to what that's going to look like when it does finally come to fruition. So I don't know. What we do know about recessions is the yield curve does lead a recession by about 12 to 18 months. We've been inverted for several months now, so we could see recession early, the end of this year, early 2024, which could mean that we could have a really good 2024 and then fall off the cliff and have that, whatever that is going to be. Fed pivots do occur before market drawdowns. Now, they haven't pivoted yet. That would mean when they stop raising rates and they start lowering rates. When that starts happening, that usually does precede the market drawdown, but we're not there yet. They are still talking about raising one more quarter point on the next meeting, and that's next month. Then they may stop for the summer. So even in that scenario, we're looking at the second half of this year before we start to see full-on negative effects in the markets. Unemployment should eventually spike. We are seeing a lot of tech still laying off, a lot of manufacturing still laying off in the U.S. across all sectors now, but it's not fully showing in the unemployment numbers, which I'm just finding fascinating. So I don't know what I'm missing there, but something isn't adding up. Money is tightening. Banks are lending less, and that does precede these kind of situations where we have recessionary, cheap and easy money is what creates growth. And when that goes away, the opportunity for growth does get stopped fairly quickly. And yesterday was wild. Even Will was talking about the good news comes out and things change. The inflation numbers came out. It was good. The market shot up. It actually shot up an hour before the market opened. But then once it opened, it just kind of meandered down and went negative midway, for lunch. Then it was positive again. But then the Fed minutes came out, and that apparently wasn't good. Although the news wasn't that bad, but the market sold off on that. So it's tough to keep track of. Do we like bad news? Do we like good news? Do we sell off on one or buy the other? It's a very confused market out there. So it's hard to say where we're at, but it's fascinating out there. I still think we're in a good spot. The momentum's with it, and I'll show you that in a minute. Our long term is still positive. It's just playing on the edge, but we did have a good run up out of there. So there's not too much to mention. Money flow has been positive, although like Will said, for the past 8 to 10 days, trading days, a couple of weeks, the market's been sideways, really, depending which index you're looking at. Some are down a little bit, some are flat. But the money flow has been coming out, but it doesn't mean the market's done. And today is actually a good example of the market continuing upwards. To show you this, we talked about this a couple webinars ago. Actually, last webinar, we said, I'd love to see this come down and test this number, and it did. Actually, think the webinar happened right there. So we did have a bounce, and then we fell, and then we raised. But what has to happen now, we have to come above this level. And this is about 4,200 on the S&P. We need that to go to 42, 43 before we really say, okay, now we're getting new highs each time. That is a marker of improving markets. And then we have our higher low, higher each time. If this goes up to 42, 43, it comes down to about 44,000. Great. Then we are in an uptrend, and that's changed the environment. But it's interesting how much symmetry there is in the market when you look at these things this way. These sectors are all positive right now, but technology went negative. Although I'm going to bet today it flipped back a little bit. So our sectors are positive. What's interesting is the communications are positive, but these three that have the momentum with them are defensives, right? That's consumer staples, utilities, and healthcare. Healthcare has been a mess lately, but with technology, they led the way out of this bottom, and they're leading the way off at the top. So it's possible that we'll see that rotation as this market peaks. That's how it's going to happen. So see what happens there. Here's a visual example. Here's technology kind of heading down towards weakening, as is communications. But financials, which have been, they got beat up the worst. So here they are coming back. they're improving and they could be leading. They're the most sold off thing right now. So I'm looking at them as they might be a good buy for a short period of time. I don't know yet, but I'm certainly looking at it. Energy is strong, getting weak. Real estate's popped up in here. Industrials are having a weak day, but everything is moving into that leading box. And that's what we want to see versus T-bills. So that means it's worth it being invested versus not. And we're still seeing that. And as Will said, we are about 75% invested in most of our models right now. And all the indexes that we follow to kind of give us a benchmark of should we not be invested are green. All the rotations are green. Directional momentum is green. So all the things, all the indexes, everything is really on the left side of the box, right? That's all the good side. And eventually those will start peeling off and moving to the right before things get ugly. But right now it's not bad. This has been an interesting thing because as the banks had a really, really tough time, the S&P has more banks than the NASDAQ does, right? For example, and we think of this when we're doing market neutral, and we still run some of that right now. What was happening, and this was the run up, was every day the market was going down for these things. It was really through here. Some really ugly days. But what happened is the NASDAQ was fine because it didn't have bank exposure. So it was going down, but not very much. But the S&P has a lot of bank exposure, 20, 30, 20, 25%. So it was going down more than the NASDAQ was falling. So the spread actually was working in our favor. So we actually had a good bunch of days. But what happens in this not rotation, but this ratio is it'll run for a while and then just go sideways. It'll run for a while, then it just goes sideways. This is getting to where it's weak and we're getting concerned about it, where we think it could shift. If we have the S&P getting stronger than the NASDAQ, that could also be a negative factor because usually it was. You don't want to see the NASDAQ being weaker. That's growth. You want to see the growth lead the market forward. So that's where we're at. I'm curious to see if this happens today. The NASDAQ is much stronger than the S&P, so this is going to be bouncing right off of this level. So we'll have to see where it goes, and we run market neutral that way.